Hi everyone, welcome back to Velocity Banking Together. I'm Michelle. In our last video, my husband Duan introduced who we are and why we started this channel. But today, I'm going to break down one of the most important parts of the Velocity Banking strategy, something that most people overlook, and that's cash flow. So let's get into it. So what is Velocity Banking? Velocity Banking is a smart, simple strategy to help you pay off debt faster using the money that you already have. The idea is this. Instead of just making minimum payments or following a strict monthly budget, you start thinking in terms of cash flow, the money you have left over after paying all of your bills. You can use a financial tool like a HELOC, a personal line of credit, a credit card, or an all-in-one loan, and you flow your income into that line. That money immediately lowers your principal balance, which means you pay less interest. Then you pay your regular expenses from that same line. The goal is to accelerate your debt payoff using your cash flow in a more strategic way. So to start, let's talk about traditional banking compared to velocity banking. In traditional banking, your income goes into a checking account and it just sits there. Then you pay your bills throughout the month and maybe try to save what's left, if anything. But in velocity banking, your income goes into a line of credit that immediately reduces your debt balance. So instead of waiting until the end of the month to make progress, you're reducing your debt daily and paying interest only on what's left. It's just a smarter way to use your money that you're already earning. So why is cash flow everything? Why is it so important? Because cash flow is the fuel that powers velocity banking. It's not about how much you make. It's about how much you keep. You need to know exactly how much is left over after each month, after your bills are all paid. That's your positive cash flow. And that's what you'll use to chunk down your debt faster. So first, let's go over how to calculate your cash flow. So first, figure out your income after taxes, how much you bring home every single month. So for example, let's say you make $6,000 a month. You total up all your monthly expenses, everything from your rent or mortgage, groceries, gas, all of your subscriptions. And let's say all of those expenses total up to $5,200. So then you subtract the two. So the $6,000 that you bring home minus the $5,200 equals a positive cash flow of $800. That $800 is your weapon. That is what you can use to make big chunks against your debt. So while most people budget, but very few take the time to calculate their actual cash flow. And honestly, it's the number one thing you need to make this strategy work. So now that we talked about cash flow and why it's important in the velocity banking strategy, let's take a look at what's coming next. In our next video, we're going to teach you the chunking method, how to make strategic lump sum payments on your debt using your line of credit. We'll also talk about which debt to chunk down first, how much to chunk down at a time, and how to avoid over leveraging yourself. So be sure to subscribe, give this video a thumbs up, and let us know in the comments what's your monthly cash flow right now. Is it positive or is it negative? We're here to simplify this strategy and walk it out together with you. Thanks again for watching Velocity Banking Together. Don't forget to follow us on Instagram at Velocity Banking Together. And we'll see you in the next video.